Hello, this is the first of 13 individual lectures using John Wilde's 8th edition of Financial Accounting. Let's dive in. So the learning objectives for Chapter 1 are broken down into three main buckets: conceptual, analytical, and procedural. So we'll cover things like the importance of accounting, what is accounting, some of the generally accepted accounting principles, and then we'll spend some time and work through some various examples, analyzing the accounting equation and each of its components. And then ultimately, we'll learn how to identify and prepare basic financial statements and talk about how they interrelate. So our first objective is to explain the purpose and importance of accounting. So what is accounting? So oftentimes accounting is referred to as the language of business. And the reason for that is it's basically an information and measurement system that identifies, records, and communicates information that's relevant and reliable about an organization's activities. Next, we will identify the users, uses of, and opportunities in accounting. So there are two buckets of users of financial information. There's external users and internal users. Simply stated, internal users are those folks within the organization, so the organization's officers, managers, internal auditors, and the like. And then external users are anybody outside the organization, so shareholders, lenders, external auditors, governments, customers. You get the idea. So there are many opportunities in accounting. Primarily, you'll find positions that fall within the financial realm, the managerial realm, or the taxation. We won't talk a whole lot about these here today, but you can read about all of the opportunities in accounting further in the book. Okay, so let's take a few minutes and see if we can identify whether each of these users that are listed are external or internal. So remember that external users are those that are not directly involved in running the organization. They are outside the organization. And internal users are those that are directly involved in managing and operating the organization. So take a few minutes, write down whether each of the following is an internal or external user, and then we'll review the answers. Okay, so a regulator, is that an internal or external user? That's right, external. CEO, internal. Shareholder, it's external. Controller, it's internal. Executive employee is an internal user. External auditor, they kind of give it away with the title. That's an external user. A production manager, that's somebody that is directly involved in managing the organization, so that's an internal user. And a non-executive employee is an external user. Those are folks that aren't directly involved in running the organization, and that's why they're calling that an external user. Okay, hope you did well on those. So let's move on to learning objective 3. So ethics and accounting. Okay, so the thing about ethics, it's not that it's not my length of time that I'm going to spend on these next couple slides has nothing to do with the level of importance or lack thereof of this particular topic. It's just that I want to make sure that I leave plenty of time to go through the things that are more complex and require some explaining. Whereas the ethics pieces, you can read about that in the book, and I think you'll be able to grasp those concepts well enough that there's not a reason for me to dwell on it or spend a whole lot of time on it in this lecture. But the one thing I will say is that obviously ethics are very important and extremely important in accounting in light of all of the companies that have gone down because of unethical behavior. But the basic premise is that the goal of accounting is to provide useful information. In order for that information to be useful, it has to be able to be trusted. And so if you have people that are cooking the books and making things up, that information no longer becomes useful. So kind of the overarching, I guess, summary is that ethics are very important, but I am not going to spend a ton of time on them here in this lecture. so that we can save time for the things that are a little bit harder to grasp by just reading them in the book. The one thing I will mention is the fraud triangle. So the thing that you want to know here is that the fraud triangle, there must be three factors that exist in order for a person to commit fraud. And this was developed by a model that was developed by a criminologist. And that criminologist says that opportunity, rationalization, and financial pressure, all three must exist in order for a person to commit fraud. And so the thing that I would say is that the rationalization and the financial pressure pieces of the triangle, um, as an employer, you can't really do much about either one of those. That has a lot to do with the individual's own personal ethics. But the opportunity piece of the triangle, a lot of employers will put in place mitigating factors, such as pre-employment background screenings and things like that, uh, to try to reduce that risk. All right, so our next learning objective is the generally accepted accounting principles, and we'll define and apply several of these principles in the slides to come. So financial accounting is governed by these concepts and rules that we call GAAP, or generally accepted accounting principles. And the purpose of GAAP is so that financial statements can be relevant, reliable, and comparable across different organizations. So the standard setting body is technically the Securities and Exchange Commission, but they've delegated their responsibilities, so to speak, to what we call the Financial Accounting Standards Board, or the FASB. And they're basically the private sector group that sets GAAP. So in today's global economy, there is increased demand by external users to be able to compare financial statements, even if the organizations are from different areas of the world. And so the FASB and the ISAB, the International Accounting Standards Board, are in the process of creating this convergence that's aimed to basically create a single set of accounting standards for global use. So it doesn't matter where you are, everybody would be following the same set of standards. And so they're attempting to converge and enhance this thing called the conceptual framework, which broadly consists of these four categories: objectives, qualitative characteristics, elements, and recognition and measurement. And so you can read about what's going on there in the textbook. I'm not going to spend a ton of time here, again, because it's pretty straightforward. And then we'll leave enough time to be able to go through a lot of the things that are a little bit more complex about Chapter 1. Okay, so there are principles and assumptions of accounting. So general principles are kind of the overarching high level ideas or assumptions or concepts or guidelines for preparing financial statements. And then there's more specific principles that are actual detailed rules that are used to report certain business transactions and events. So there are four accounting principles, all presented here on this slide. So there's the measurement principle, which basically says that accounting information is based on actual cost. There's the revenue recognition principle that says revenue should be recognized when it's earned, and that the measure of revenue is just the amount that's expected to be received. And then the expense recognition principle, or what's often called the matching principle, is that a company must record its expenses incurred in the same period in which they report the revenue that was generated. And then the full disclosure principle is that the company is required to provide the details behind the financial statements that would impact the user's decision. So if you've ever looked at a set of financial statements, there'll be a couple pages up front, probably 3, 4, 5 pages up front, that are full of numbers. And then there'll be anywhere from, 10 to 20 to 30 pages behind it that are just paragraphs, written words. That's what we call the footnotes. And the footnotes provide additional color around the numbers that are presented in those first several pages of the financial statement that help users to understand and make effective decisions using those numbers on the financial statements. So when we're reporting the activities of a business in the form of accounting information or financial statements, there are four assumptions that are presumed to be true. And the first of that is the going concern assumption. So basically says that the assumption in the financial statements is that the business is going to continue operating instead of being sold or closed. And another assumption would be the monetary unit assumption, which just says that we can express the transactions and the events in monetary units. Then the time period assumption. So it presumes that the life of a company can be divided into time periods. So you can divide it into months, quarters, years. And then the last of the assumptions is the business entity assumption. So what that says is that the business is accounted for separately from other business entities and separately from its owner. So a business entity can take one of three legal forms. They can be a proprietorship, a partnership, or a corporation. And you can read about the differences between those in the book. We're not going to spend a ton of time on those here today. Okay, so if our job as accountants is to provide information that's relevant, reliable, and comparable, uh, that requirement is subject to two constraints. The first is this idea of materiality. So only information that will actually influence the decisions of a reasonable person is required to be disclosed. And then this idea of cost benefit. So only information with the benefits of disclosure that are determined to be greater than their cost need to be disclosed. So basically, both importance and relative size of the transactions are considered. So in addition to GAAP, back several years ago, Congress passed the Sarbanes-Oxley Act, and the purpose of the act was basically to increase transparency, accountability, and truthfulness in reporting financial transactions. And Sarbanes-Oxley Act applies only to companies who issue their stock to the public, whereas GAAP applies to all companies. But you can see here, this was the outcome of several decades and several companies who had inflated income, understated revenues, understated expenses, overstated revenues, overstated income, hid debts to avoid tax implications and all kinds of things. So uh, you can read about Sarbanes-Oxley in detail in the book, but generally the super summary thing that you need to know is just that it was passed by Congress and it applies to public companies only. And the purpose of it was to increase transparency, accountability, and truthfulness. Another thing that has come out with the intention of promoting accountability and transparency is the Dodd-Frank Act, and you can read about that in the book as well. But again, the goal of promoting accountability and transparency in the financial systems, and then also to put an end to the notion of too big to fail. So you can read about that in the book, but I at least wanted to mention it here. Okay, so why don't you take a minute and for each of the following phrases and/or terms, identify whether they're an accounting principle, assumption, or constraint. Okay, so let's review. So accounting principles are those that govern the amount and/or the timing of information that's required to be reported in financial statements. So the first principle was the measurement principle, and that's also referred to as the cost principle. Basically, your cost is measured on a cash or equal to cash basis. So whatever you pay for it, that's what you report it at on your financial statements. And then it also governs the valuation of the assets and liabilities on your balance sheet. The second was the revenue recognition principle, which governs the timing of the revenues recognized on your income statement, recognized when they're incurred, okay? Or earned, rather. The third is the expense recognition principle, which is also called the matching principle, and it governs the timing of expenses that are reported on your income statement. So basically, the expenses that you incur in order to generate whatever products or revenue you're selling need to be reported in the same period as the revenue that they help generate. And then the full disclosure principle says that a company must report the details behind their financial statements that would impact user decisions. And those disclosures are often found in the footnotes to the financial statements. Those are those pages that follow all of the pages with the numbers on it that we were talking about just a little bit ago. Okay, so the assumptions, they're generally related to financial statement headings. So you've got the going concern assumption, which is a presumption that the business will continue to operate into the future instead of being closed or sold. Then you have the monetary unit assumption that says that we can express transactions and events in monetary units, so i.e. the dollar. We have the time period assumption that presumes that you can chop up the life of a company into periods of time that are useful for reporting, so a month, a quarter, a year. And then we have the business entity assumption, which assumes that the business is accounted separately from other business entities and separately from its owners. Then we have the accounting constraints that are basically reasonableness of information that's to be reported. So you have the two constraints. The first is materiality, so only information that will influence the decisions of a reasonable person is required to be disclosed. And materiality is a function of the nature of the item and or the dollar amount. So it's not strictly just the dollar amount. If it's a significant transaction to the organization, it may also be required to be disclosed. And then the benefits exceed the costs, so the benefit of the information disclosed must be greater than the costs of providing the information. Okay, so let's see how you did. Materiality, is that a principle, assumption, or constraint? It's a constraint. Measurements, A, B, or C? Measurement is a principle. The business entity is an assumption. Going concern is an assumption. Full disclosure is a principle. Time period is an assumption. Expense recognition is a principle. And revenue recognition is a principle. So I hope you did well on those. And let's move on to the next. Okay, we didn't spend a whole lot of time on this particular slide in the recorded lecture here, but hopefully you've read through the book and you're able to answer this question anyway. So we'll briefly run through it. So we're being asked to complete the following table with either a yes or a no regarding the attributes of a partnership and a corporation. So is a partnership business taxed? Yes or no? No. What about, is a partnership a limited liability? No. Is a partnership a legal entity? No. And does a partnership have an unlimited life? No. What about for a corporation? Yes, a corporation is business taxed. Yes, they are a limited liability. Yes, they are a legal entity. And yes, they're presumed to have an unlimited life. Okay, so our next learning objective is to define and interpret the accounting equation and each of its components. So this is where it gets real fun. So hang with me here, and we're going to go through a bunch of different examples. And I would encourage you that if through the first time through this does not click for you, that you take time to listen to it a second and or a third time, because this is the basis upon which everything in the course will build. And so it's critical that you understand and are able to follow the stuff that we're going to discuss here in the next few slides. So the accounting system reflects two basic aspects of a company: what it owns and what it owes. The assets are the resources that a company owns or controls. And so examples of assets would be things like cash, supplies, equipment, lands, vehicles, those types of things. And then the claims on that company's assets, what they owe, can be broken into two buckets: owner and non-owner. So liabilities is the term that we assign to what a company owes to its non-owners in future payments, products, or services. And then equity is also called owner's equity or capital, and it refers to the claims of the owners. And so together, the liabilities and the equity are the source of the funds a company uses to acquire assets. And so on the left side of your equation, you have assets, and on the right side of your accounting equation, you have liabilities and equity. So the equation in its simplest form is assets equal liabilities plus equity. So the accounting equation can be expanded as follows. So assets equal liabilities plus equity is essentially contributed capital plus retained earnings. And so retained earnings is really the accumulation of all of the company's profits and losses over the entirety of their life, less any dividends that have been paid to any shareholders over that life. So you can even break the accounting equation down even further and say that assets are equal to liabilities plus common stock, less dividends, plus revenues, less expenses. And so revenues less expenses is really your net income. So using what we've previously learned on the slide just before, let's solve for the missing pieces in these two equations. So Bo's company has $150 in assets and they have $30 in liabilities. So if the accounting equation is that assets must equal liabilities plus equity, $150 less 30 means their equity is $120. And then Vogue company, liabilities are $100, equity is $300, and so assets must be $400. So let's do an example with the expanded accounting equation. So Tesla has $200 in assets and $85 in liabilities. So if assets must equal liabilities, that means that their equity has to be $115. 115 plus 85 equals 200. So now, if we know that their common stock is 100, that their dividends are 5, that their expenses are 40, what are their revenues? So the thing to remember with the accounting equation is that common stock increases your equity, dividends decrease your equity, revenues increase your equity, and expenses decrease your equity. So $100 minus 5 is 95, minus 40 is 55. So what number plus 55 equals 115? $60. Then YouTube has assets of $400, liabilities of $160. So that must mean their equity is $240. And then the expanded accounting equation. So if we know that their common stock is $220 and their revenues are $120 and their expenses are $90, what must their dividends be? So if you take $220 plus $120, that's $340, less 90 must mean that their dividends are $10. Okay, so now we're going to analyze business transactions using that accounting equation that we just learned. So in transaction 1, Chaz Taylor invests $30,000 cash to start a company. So the thing that we're going to want to do in each of these transactions is first identify the accounts that are affected. Are the balances going up or down? And by how much? So the accounts involved in this transaction is cash and common stock. So he's giving the company cash, so the company's cash asset is going to increase. And the company is going to issue Chaz Taylor common stock, and so their equity balance is also going to increase. And so if we were to look at this in the form of the accounting equation, our asset account is going up by 30, our common stock account is going up by 30, and at the end of the day, our assets still equal our liabilities plus our equity. In transaction 2, the company purchased supplies by paying $2,500 cash. So what two accounts are affected? Our cash account is going down because we're paying money out to purchase supplies. And supplies in this case is considered an asset account, and so our asset account, supplies, is going to increase. So if we were to look at that in the form of the accounting equation, we have our cash going down by $2,500, and we have our supplies increasing by $2,500. So our total assets are at $30,000, and our total liabilities are at $30,000. So we are still in balance. Transaction 3. So the company purchased equipment for $26,000 cash. So the two accounts that are involved are cash. We're paying out money, so our cash asset account is going to decrease, and our equipment asset is going to increase. So if we look at this in the form of the accounting equation, we've got equipment for $26,000. We have cash decreasing by $26,000, and our accounting equation still remains in balance. In transaction 4, the company purchased supplies of $7,100 on credit. So you can buy assets one of two ways typically, either with cash or on credit. And when you buy something on credit, we have what we call an accounts payable. So our supplies asset account is going to increase, and our accounts payable, a liability, something we owe to our supplier sometime in the future, is going to increase as well. So if we look at it in the form of our accounting equation, we're increasing our supplies account by $7,100, and we're also increasing our accounts payable account by $7,100. So our assets are going up and our liabilities are going up as well, and our accounting equation is still in balance. So now if we look at some transactions that involve revenues, expenses, and dividends, Transaction 5 says that we provided consulting services to a customer and we received $4,200 of cash right away. So the two accounts that are affected here are cash, it's going up, the customer paid us, and revenues are also increasing. And if revenues are increasing, equity is also increasing. So in our accounting equation, we provided consulting services to a customer and received $4,200 cash right away. Our cash is going up by $4,200 and our revenue is going up by $4,200, which in turn is increasing our equity by $4,200 as well. And our accounting equation is still in balance. So transactions 6 and 7, we paid rent of $1,000 and we paid salaries of $700 to our employees. So the accounts that are involved, our cash is going to go down. We're paying money out the door for expenses. Our rent expense is going to go up, which means our equity is going to go down. And our salary expense is going to go up, which means our equity is going to go down. So if you think about the expanded accounting equation, it said that assets are equal to liabilities less dividends plus common stock less expenses plus revenues. So even though your expense amounts are increasing, your expense amounts have an inverse relationship with equity. So the more expenses you have, the less equity you have. So if we were to look at this in the accounting equation, we have cash going down by $700, cash also going down by $1,000, and our expenses are going up, but the way that they're being presented here on this slide is in their relationship to equity. And so equity is decreasing as our expenses are increasing, which is why they're presented there as negative numbers. And so assets are still equal to our liabilities plus our equity. Okay, so in transaction 8, we're providing consulting services of $1,600 and rents facilities for $300 to a customer on credit. So we're providing consulting services and we're making some rental income for a facility that we rented to a customer. And they're not paying us cash right away, but they're going to pay us in the future. And so when that happens, we have what we call an account receivable. So it's money we're owed today, but the customer's not yet paid us. And so rather than recording cash, we're going to record an account receivable, which is an asset account. So that balance is going to increase. And then we're going to recognize the revenue, and revenues are also going to increase. And revenues have a similar relationship to equity. So when revenues are increasing, equity is also increasing. So if we look at these transactions in the form of the accounting equation, you have your accounts receivable of $1,900. You have your revenue of $1,600 for the consulting services. Then you also have revenue of $300 for the rental income for renting the facility. And then our accounting equation is still in balance. So in transaction number 9, the client in transaction 8 paid us for that $1,900 of consulting services and rent. So the accounts that are involved is our cash is going to go up. We're collecting cash from our customer, and our account receivable balance is going to go down because they no longer owe us. They've paid us. So if we look at that transaction in the form of the accounting equation, you have your cash that you're receiving of $1,900. Your accounts receivable is decreasing for $1,900. So your total assets aren't changing. The balance is just basically moving from one account to the other. And your accounting equation is still in balance. All right, so in transaction 10, Fast Forward pays $900 as a partial payment for the supplies that we purchased in transaction 4. So when we purchased those supplies in transaction 4, we recorded an accounts payable and we recorded supplies. So our cash asset's going to go down because we're now paying for those supplies. And we're going to reduce our liability because we've paid some of that balance. So Fast Forward pays $900, our cash is going to decrease. And we've also paid part of our accounts payable, and so the balance that was $7,100 previously is now decreased by the $900 that we've paid. And our accounting equation is still in balance. Okay, so in transaction 11, dividends of $200 are paid to shareholders. So the accounts that are involved here are cash and dividends. And if you remember, the expanded accounting equation is assets equal liabilities plus equity plus common stock less dividends plus revenues less expenses. So our dividend account is going to go up because we're paying dividends to our shareholders, but like expenses, dividends have an inverse relationship with equity, and so our dividend account is going to go up, but our equity is going to go down. So if we were to look at it in the accounting equation, we have our $200 reducing our cash, we have our $200 in our dividends, and although the dividend account is going up, the way that it's presented here is as a negative number because it's reducing our equity because it has that inverse relationship with equity. And our accounting equation is still in balance. Okay, need to know 1-4. Let's see if we can apply what we've just learned with the following example. So assume Tata began operations on January 1st and completed the following transactions during its first month of operations. On January 1st, they received an investment of $4,000 cash in exchange for its common stock. January 5th, they purchased $2,000 of equipment on credit. On the 14th, they provided $540 of services to a client on credit. And then the company paid $250 cash to an employee for salary. So let's arrange the following asset, liability, and equity titles in the table like we did throughout the example exercises. And we'll fill in what we know. So on January 1st, they received an investment of $4,000 cash in exchange for common stock. So the first question you should ask yourself is what accounts are affected? So cash and common stock, right? So our cash is going up by $4,000 and our common stock is going up by $4,000. On January 5th, the company purchased $2,000 of equipment on credit. And so on January 5th, what two accounts are affected? Well, they bought equipment, right? So our equipment account is going up by $2,000. And when they buy something on credit, they're not paying for it now, so it doesn't affect your cash account, but it does affect your accounts payable. Accounts payable is money that you owe now, but you're going to pay later. Then on January 14th, the company provided $540 of services for a client on credit. So when they're providing the services to that client, the client's not going to pay them now, so they're not going to have cash now, but they are going to have an account receivable. And then they recognize revenue of $540. Then on January 21st, the company paid $250 cash for an employee's salary. Well, what two accounts are affected? Cash and expenses. Expenses are going up, but the relationship to equity is that equity will decrease, which is why it's being presented as a negative number. And if we add up all of our balances, total assets are $6,290, total liabilities are $2,000, and total equity is $4,290. So do your assets equal your liabilities plus your equity? Yes, they do. Okay, moving on to our next learning objective, we're going to talk about the basic financial statements and explain how they interrelate with one another. So there are four financial statements. The income statement, the statement of retained earnings, and the statement of cash flows are all for a period of time, and the balance sheet is as of a point in time. So the income statement describes the company's revenues and expenses and computes the resulting net income or net loss for a period of time, which is typically a month, a quarter, or a year. The statement of retained earnings explains changes in equity from net income and from any dividends that are paid over a period of time as well. So that could be a month, a quarter, a year. The balance sheet is different in that it describes the company's financial position as of a point in time. So you would have a balance sheet as of October 31st or as of December 31st. And then finally, the statement of cash flows, again, is for a period of time, and it basically identifies the company's sources and uses of cash over whatever that identified period of time is. So the financial statements and their links. So here's an exhibit of the financial statements and how they interrelate. And ultimately what this is showing is the results of all of the activity that we just went through and we laid out in the form of the accounting equation. If you were to sum up all of the increases and decreases in each of those accounts, that's ultimately what's being presented here. So the income statement is for a period of time, in this case for the month of December 31st of 2016. And it shows revenues at the top and expenses at the bottom. And the difference between your revenues and your expenses is what we call net income or net loss. So if your revenues exceed expenses, you have net income. If your revenues do not exceed expenses, you have a net loss. And so your net income ultimately flows from here down to here on your statement of retained earnings. So your statement of retained earnings starts with retained earnings at the beginning of the period. So because we're presenting the statement for the month of December 31st of 16, we start with the December 1st balance in retained earnings, which is 0. The company just began. We're going to add our net income or subtract our net loss if we had a net loss. And then you subtract any dividends that were paid. And you get to the ending retained earnings balance as of December 31st of 2016. Then your retained earnings flows down here to your balance sheet. So the way your balance sheet is set up is you typically have your assets at the top or the left, depending upon how it's presented. Then you have your liabilities on the right or in the middle, and then your equity at the bottom or on the right, depending upon how your balance sheet is presented. So the thing to know here is that your statement of retained earnings or ending balance in retained earnings, which is what I said earlier was the accumulation of all of the profits and losses of the business for the entirety of their existence, less any dividends that they've paid to their shareholders, comes down here in your balance of retained earnings, which is in your equity section of your balance sheet. And then your cash, if we move on to the next slide, your cash balance from your balance sheet ultimately should match your ending balance on your statement of your cash flows. So the statement of cash flows is presented in three major sections. You have cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. And the subtotal of each of those are added together to determine whether you have a net increase or a net decrease in cash. That net increase or net decrease then is added to your cash balance at the beginning of the period. In this case, it was 0. And that's how you derive the ending cash balance that should match your cash balance on your balance sheet. Okay? Okay, let's prepare our income statement, statement of retained earnings, and balance sheet for Apple Company using the following data. But before we do that, let's review the accounting equation and how the pieces parts interrelate with one another. So our accounting equation is assets equal liabilities plus equity. And if we were to expand equity, we would say that equity is equal to common stock plus revenues less dividends plus expenses. So let's place the pieces parts of the accounting equation into the appropriate column for the statement that they belong. So on the balance sheet, you have your assets and your liabilities and your common stock. Then on your statement of retained earnings, you have your beginning balance of retained earnings less your dividends. On your income statement, you have revenues less expenses, which equals net income. That net income flows to your statement of retained earnings. So then you get beginning retained earnings less dividends plus net income or minus net loss for your ending retained earnings. And then your ending retained earnings flows to your balance. Okay, so let's place each of your accounts under the appropriate heading of the statement for which they belong. So as a reminder, on the balance sheet, you should have your asset accounts on the left-hand side, your liability accounts on the right-hand side at the top, and then your equity accounts on the right-hand side at the bottom. So accounts payable is a liability account, so we'll bring that down to our balance sheet for $30,196. Other liabilities, what type of an account is that? It's a liability as well, right? The heading kind of gives it away. So we have other liabilities of $90,096. Then we have cost of sales, which is an expense. And the income statement reports our revenues and our expenses, right? So we'll bring our expenses down here. Cost of sales, $112,258. Then what about cash? Cash is an asset account, right? So that belongs here on our balance sheet for $13,844. And then retained earnings as of September 28th, 2013. So their fiscal year end is September 27th. So that's the beginning balance of retained earnings there. So that goes on our statement of retained earnings. Then we have dividends that they paid during the fiscal year 2014. Dividends belong on our statement of retained earnings. We're going to subtract those, so $56,614. Then we have revenues. Those belong on our income statement for $182,795. And then we have investments and other assets. Kind of gives it away in the heading, right? That's an asset account. So that belongs over here on our asset side of our balance sheet. And we have land and equipment. So land and equipment are also assets. So place those there. Then we have selling, general, and other expenses. That belongs on our income statement. Then we have accounts receivable. Accounts receivable is an asset account, $17,460. And then we have net income. Net income belongs on our balance sheet. Oh, they're skipping down to common stock. So let's go to common stock. Common stock belongs on our balance sheet in the equity section for $24,395. Then we have net income. So $182,795 minus our total expenses of $143,285 is $39,510. And then finally, our net income flows over here to our statement of retained earnings. So we have retained earnings beginning of 104 plus net income of 39,510 for a total of 143,766 less our dividends equals ending retained earnings of 87,152. And that ending retained earnings flows down here to our balance sheet. So we have total assets of 231,839, total liabilities of 120,292, total equity of 111,547 for a total of 231,839. Our balance sheet is in balance, so we know we've done that correctly. Okay, so accounting according to US GAAP is similar but not identical to IFRS or International Financial Reporting Standards. So here's some of the basic principles of US GAAP and IFRS, they call it for short. You can read through those in the book. I'm not going to spend a lot of time here in the lecture discussing them, but it is something that you should know in case you get a multiple choice question on an exam. So again, some more information regarding transaction analysis of US GAAP and IFRS. Again, not something we're going to discuss here, but read about it in the book at least enough, become familiar enough that you could answer a multiple choice question if you get one on the exam. Okay, so our next learning objective is to compute and interpret the return on assets. So at the end of every chapter, McGraw-Hill will present some kind of a analysis tool or computation that's used in analyzing financial statements. And so at the end of this chapter, they talk about the return on assets. And so return on assets is a profitability measure, and it's useful in evaluating management and analyzing and forecasting profits and planning activities. And so it's stated in ratio form, and it's calculated as net income divided by average total assets invested. And so oftentimes when we're looking at these analysis tools, they're really no good in and of themselves generally. What you want to look at is the answer to the analysis tool, either over a period of time for the same company, or perhaps in comparison to like an industry average, or in comparison to competitors. And so the return on assets here is again calculated as net income divided by average total assets. And the example that they show is the return on assets for Verizon, both over a comparison of Verizon's own history and compared to the industry. Okay, so in Appendix 1A of Chapter 1, they go through an explanation of the relationship between return and risk. So net income is often linked to return. So return on assets is stated as a ratio in the form of income divided by assets invested. So for example, banks report return from a savings account in the form of interest returns such as 4%. So if we invest in a savings account or in US Treasury bills, we would expect a return of around 2 to 7%. So how do we decide among the investment options? Well, the answer depends on our trade-off between return and risk. So all business investments involve risk, but some of them involve more risk than others. And so the lower the risk of the investment, the lower typically the expected return. And so this is just an example of a bar graph of some recent returns, and actually I'm not even sure how recent they are. They're probably a couple years old at this point, but it shows the returns for US Treasury versus a low risk corporate investment or a medium risk corporate investment and a high risk corporate investment. And so as you can see, the lower the risk, the lower the interest rate. Okay, so let's identify and describe the three major activities of organizations. So there are three major types of business activities. Financing activities provide the means that organizations use to pay for their resources, such as land, buildings, and equipment, to carry out whatever the plans for the business may be. So the organizations are pretty careful in acquiring and managing those financing activities because they can determine ultimate success or failure. So the two sources of financing are owner and non-owner. So owner financing refers to the resources that are contributed by the owner along with any income the owner leaves in the organization. And then non-owner or creditor financing refers to the resources contributed by creditors or lenders. So financial management is really the task of planning how to obtain the resources and set the right mix between owner and creditor financing. So investing activities are the acquiring and disposing of the resources or assets that an organization uses to acquire and sell its products or services. So these assets are funded by an organization's financing, and it differs organization to organization on the amount and the makeup of the assets. So some require land and factories to operate, others only need an office. So determining the amount and the type of assets that an operation needs is called asset management, and the invested amounts are referred to as assets. So the financing is made up of creditor and owner financing, and those creditors and owners hold the claims on the company's assets. So the creditor's claims are what we call liabilities, as we mentioned earlier in this lecture, and then the owner's claims are called equity. So the last activities are the operating activities, and they involve using the resources that the company has to research, develop, and produce and distribute the products and services of the company. And so sales and revenues are considered the inflows of assets from selling those products and services. And then costs and expenses are the outflows of the assets to support the operating activities. So strategic management is the process of determining the right mix of operating activities for the type of organization, its plans, and the relevant market. So this illustration kind of summarizes the business activities. So planning is really a part of all of the activities and helps give meaning and focus to the individual activities as they are happening in the organization. Investing assets and financing liabilities and equity are set opposite each other to stress their balance. So the operating activities below the investing and financing activities show that the operating activities are a result of the investing and financing activities. Okay, so this concludes our lecture for Chapter 1. As you work through the homework, if you have any questions, please don't hesitate to reach out. We'll see you next time.